Hello, it's 7 o'clock. Good evening, everyone. This is Yang Wang. Welcome to today's program. Before we start, let me give a brief introduction of the speaker for today. Dr. Henry Mamaysky is a partner at QuantStreet Capital, which offers its clients model and market analytics, wealth management, and investing service through separately managed accounts. Henry is also a professor at the Columbia Business School, where he is the director of the program for financial studies. Henry's research focuses on the application of quantitative techniques to investing and financial planning. Henry is a frequent industry and academic speaker. Prior to Columbia, Henry spent years in finance practice, rising to senior portfolio manager at Citigroup and later serving on the firm's risk executive committee. Henry was a professor at the Yale School of Management, which he joined later after he earned his PhD in finance from Massachusetts Institute of Technology. He holds BS and MS degree in computer science and a BA in economics from Brown University. Now let me turn the screen to Professor. Thank you.
Great. Thank you very much for that introduction. Let me share my screen, and then you can just confirm that you can see my screen. Hold on, I'm going to share it. Okay.
Yeah, it's coming.
Okay, great. Thank you. So great. Hi, everyone. Nice to have you here with us today. Let me just make a brief announcement at the beginning. If you would like to ask a question at some point, please just feel free to either raise your hand, and then I can see if I see a raised hand, I will pause, or you can just unmute yourself, even go on video if you would like, and ask a question. And if we have questions, that would be wonderful. It makes it more interactive and fun for everyone involved. So my name is Harry Mamaysky. I come to you from QuantStreet Capital as well as Columbia Business School. At QuantStreet, we are a registered investment advisor. We work with clients to understand their risk tolerance or financial planning needs, liquidity, spending, savings needs, and so on. Our approach is very quantitative, very data-driven. We use data science and latest innovations in analytics and financial economics to construct low-cost portfolios tailored to our clients' risk preferences. We help clients make all sorts of financial decisions, whether it's when to take Social Security, whether to do private equity, venture capital deals, how to think about Roth conversions, and so on. If you're interested in some of the things that I will be discussing today, feel free to sign up on our email list. You can reach it through this link, bit.ly/QuantStreet. Send us an email at hello@quantstreetcapital.com, or you can follow me on LinkedIn, and we would love to hear from you going forward. Okay, so with that bit of intro, let me jump ahead to just give a recap of what we covered last time. So this is meeting number 2 of 2 meetings. We did the first one last week. Hopefully some folks from that are here again today. So last time we covered a few kind of introductory topics on your road towards becoming an outstanding self-investor. We talked about thinking through what your investment goals are. So this is things like how much liquidity do you need in your portfolio? What sort of spending requirements do you expect your portfolio to finance? And what kind of asset growth you would like your portfolio to generate? I mentioned kind of in passing, but I'd like to emphasize it one more time, that when you have these investment needs, you might think about having multiple accounts across your portfolio. So things like tax advantage accounts, like account maybe geared towards the liquidity needs of your household spending, an account more geared towards long-term growth. It's very important to keep track of all of your accounts, like having a spreadsheet and updating it regularly. You'd be surprised how many people we talk to at QuantStreet who come to us and they have a sense of their financial picture, but they haven't actually put all the numbers together. And simply doing that exercise actually is very useful for people. So I would encourage you to do that if you haven't already done it. We then spoke about risk. And if all of this is new, or if you weren't with us last week, you can check out the video from last week's presentation on the Greenwich Library's YouTube channel. But after having discussed investment goal, part of our presentation, we talked about risk and different measures of risk. So I spoke about standard deviations. I introduced the picture of that normal distribution, the bell-shaped curve, as a way of conceptualizing the kind of uncertainty that the market presents you with. And then we talked about a concept called drawdowns. I find in talking to many folks, many investors, that they find the concept of drawdown, which is the peak to trough loss that your portfolio could experience, a much more salient risk measurement than standard deviation or volatility. So we discussed drawdowns. And we talked about the risk return trade-off, the unfortunate fact that if you want higher returns on average, you typically have to construct a portfolio that has more risk on average. So unfortunately, higher returns often come with higher risk. And when we meet with clients and discuss their investment plans, one of the first things we discuss, and certainly before we commit anyone's capital to the markets, is what the proper risk tolerance is for their investment strategy. And then sort of once we figure out a proper risk tolerance, we can back into the kind of return that might be reasonably expected at that risk level. So again, this is stuff we talked about last time. And then we introduced the concept of diversification. The idea with diversification is that, to use the old saying, you don't want to have all your eggs in one basket. And the magic of diversification is that you can generate a portfolio that doesn't give up anything on the anticipated return side of things, but that can lower the risk relative to having a very concentrated portfolio of a few, very high idiosyncratic risk securities. When you have a fairly diversified portfolio, it gets rid of that idiosyncratic risk and it reduces the risk at your portfolio level. And the reason that happens is because we discussed the concept of correlation, which is a tendency of different securities to co-move. And I showed a picture that different stock asset classes tend to co-move with each other more than stocks do with bonds. And so there is some advantage to introducing securities into a portfolio that have low correlations with the other securities that are already in the portfolio. So that's sort of a recap of our 1.5 hour discussion from last time. And let's now jump into what I want to talk about today. So I mentioned already these bullet points that we covered last time. And what I want to talk about today is the following several things. Hopefully we'll get through all of them. If not, we can share the slides with you so you can have access to this information. You can also feel free to send me an email and follow up with questions. So I want to talk about financial products. What kind of investment vehicles do you have access to out there in the marketplace? And very importantly, when we talk about financial products, I would like to talk about fees and the cost of accessing some of the financial products that are out there. So we'll have that discussion today as well. Sorry. I then want to talk about portfolio management. So once we have figured out what you can invest in, what the fees are associated with some of the investment products, how do you bring all of that information together into your portfolio? And I think that'll largely take up most of our time. Time permitting, there was a question last time about the current state of the business cycle. So I added a few slides. Actually, it's from analytics that we track at QuantStreet on a regular basis. So I just added some of those pictures. Here, if we have time, we can get to it. If not, you can get the slides and read it on your own. And finally, I will end today's session with a slide that gives you some pointers to where you can read more to learn more about the investing world, and we'll sort of encourage you to continue learning and reading and enriching your understanding of financial markets after our discussion today is over. Okay, so in terms of financial products that are available out there, there is sort of a bewildering array of of financial products that are out there. Let me just mention some of the more prominent ones. So stocks versus bonds. You've all heard of stocks. You've all heard of bonds. I'll talk about stocks versus bonds in 1 second. Give you a little bit of a feel for how they differ. Then there are mutual funds and ETFs. So ETFs stand for exchange traded funds. Those are two very common investment products that a lot of folks have in their portfolios. There's also things like commodities, real estate. There's like derivative securities like options and swaps, which we're not going to talk about today. There's, of course, crypto, which is a topic unto itself, which we will not talk about today. And then there's alternative investments like hedge funds, private equity, and private credit. Here we also add venture capital. There's a wide array of things out there that you can invest in. And let me just walk you through some of the more common ones. And again, if you have questions, if you have comments, please raise your hand, unmute yourself. I'd love to hear any of your thoughts on this material. So in terms of stocks versus bonds, bondholders, people who buy bonds issued by companies or issued by governments, are effectively lenders or creditors to the company or the government whose bonds they're buying. And the government or the corporation is the borrower. The upside of being a bondholder is that in the firm's capital structure, bondholders are senior to equity holders. So before equity holders get paid anything from a firm that's, say in distress or maybe contemplating going into bankruptcy, before equity holders get anything, bondholders need to get paid back. So that's the upside of being a bondholder. The downside of being a bondholder is there's really two downsides. You've heard of the term fixed income. The meaning of fixed income is that as a bondholder, you're promised to get paid back a fixed amount of cash flows, and whether the company does well, spectacularly well, or mediocre or whatever, it doesn't really affect how much you get paid back, as long as there's enough money to pay you back. So you don't really participate in the upside of a company should it do really well. And the other negative of being a bondholder is that bondholders don't control a company's decisions. So bonds have something called covenants, and covenants are terms that are attached to corporate bonds that restrict some of the activities that companies can do in a way that protects the current bondholders of the company. So there are some controls around what companies can and cannot do, but those controls typically are fairly weak. And the management team of a corporation and its board are really there for the service of equity holders, not bondholders. So bondholders don't really control what's going on with a company until the company enters into distress, at which point bondholders can sort of take over and become effectively the new shareholders of the company. But the upside of being a bondholder is that the equity holders, so the stockholders of a company, they don't get paid anything until the bondholders are taken care of. I'm going to just briefly show you a picture about what the meaning of this is. So consider a simple company that has $75 of debt that's due in 1 year. And on the x-axis of this chart, I show you what is the hypothetical asset value of the firm in 1 year from today. So in terms of what the debt holders would get paid back from this company if they owned 1 year debt that had a notional amount of $75, if the asset value of the company was at $75 or higher, the debt holders would just get paid back the $75 principal amount of the bonds. And regardless of how well the company does, the bondholders get paid back their $75. Actually, I think the picture here shows $70, not 75, but it's supposed to be $75. If the value of the company is worth less than the amount that's owed to debt holders, basically for every dollar that the asset value of the company is below $75, debt holders just get the entire value of the company. So basically, equity holders don't get anything until the debt holders are paid back in full. And you can see that here. So this bottom picture is the value of the equity holders' claim on the assets of the company. and it's effectively zero until the time that the bondholders get paid back everything that they were due. For every dollar of asset value that's above what the bondholders are due, the equity holders begin to get every penny of the value above what's owed to bondholders. So if the company does really well, if it has a great new AI technology and its assets grow from $75 to $1 billion, all of the upside of that company's investment strategy goes to the shareholders once the bondholders have been paid back the $75 they're owed. So you can see that for values of the assets of a company that are in this sort of highish range, the equity value of the company is quite sensitive to the asset value. So as assets move up and down, the equity moves up and down 1-for-1 with the asset value. But the debt securities are very insensitive to the asset values of the company, because for highish value of the company's assets, the value of the debt doesn't change. The debt holders just get paid back whatever they were owed, whereas the equity holders sort of participate 1-for-1 in the value and depreciation of the company. So because equity participates in the upside of the company, and because management teams are there for the benefit of the equity holders, not the bondholders, there's incentive for management teams to take on projects that could result in very high upside for the company, even though that doesn't generate a lot of upside for the bondholders. So you should think about bonds as being sort of safer, but less volatile and less exposed to the upside of the company's performance, whereas equity is riskier. And if the company does really poorly, equity can really deteriorate in value tremendously. But the equity holders are entitled to all of the upside appreciation of the company as well. So that just gives you a brief, a quick sense of what the difference is between bonds and stocks of a company. And when we talk about government bonds behave a little bit like corporate bonds in the sense of they are, quite insensitive to the overall economic performance of the economy. They're less sensitive than stocks are, and they're safer than corporate bonds. But they have the feature. They share the feature with corporate bonds that they are, safer, but they give you sort of a fixed amount of upside. They basically just promise you like a certain coupon payment, a certain return of principal, and if the economy does really, really great, your bonds don't pay you back any more money than if the economy does poorly. So in fact, government bonds tend to do well during times of economic weakness, and tend to do more poorly actually during times of economic strength, at least in the US. So again, let me say, if you have any questions, please unmute, ask. I'd love to hear any thoughts or questions that you have. So that gives you a little bit of a sense of how stocks and bonds are different. The other two asset classes that are very important for most investors' portfolios are open-end mutual funds and ETFs. ETFs are exchange-traded funds. The first open-end mutual funds were launched in the 1920s of the U.S. and actually in the U.S. and actually a few of those very old mutual funds are still around today. We give you a link here after the talk. You can go click on that, and you can actually see a list of some of the original mutual funds that survive to this day. There is a wonderful publication put out by the Investment Company Institute, which is a think tank supported by the mutual fund industry, called the ICI Fact Book. And it's an annual publication. They update it basically annually, and it gives you a lot of wonderful statistics about the state of the asset management industry in the US. If you've never checked it out and you want to learn more about ETFs, mutual funds, these other things called closed-end funds, which I'm not going to talk about, you can click on that link and they'll sort of take you through some of those statistics. So globally, fund companies manage something like $75 trillion of assets. So in the US, funds manage something like $40 trillion of assets. So this is a very, very large industry, and it's an industry that's been growing. What's been happening over time is more and more of investment decisions have been delegated by individuals towards mutual fund managers, towards ETFs, and for various reasons that we'll actually talk about in a few minutes. Individuals typically manage sort of fewer and fewer of their own funds, and they really delegate the management of their funds to the professionals, who offer, very low cost, efficient exposure products to let people, participate in broadly diversified pools of bonds and stocks. So I'll give you some examples of that in a second. Over the last decade or so, there's been a large inflow of funds into exchange traded funds. One of the reasons for that is because exchange traded funds are a more tax efficient structure in some ways than ETFs. But open-end funds, mutual funds that you might already be invested in, behave in slightly different ways compared to ETFs. So let me just give you a brief overview of how these products differ. So mutual funds are basically traded at the end of every day at something called their net asset value. The net asset value is published after the market closes every day by the I forget the name, by the record keeper of the NAV for a given mutual fund. Actually, State Street does a lot of this business for mutual funds. So by about 6 p.m., 7 p.m. every day, the sort of the bean counters calculate the values of all of the securities owned by a mutual fund and say that a single share of the mutual fund, based on today's closing prices, is worth $25. And then for people who are looking to invest, so they put in $100 to invest in this mutual fund, they would be able to buy 4 shares because each share was calculated to be worth $25, given how if the composition of the mutual fund and that day's closing prices. For people who want to sell, they own a certain number of shares and they sell, today I want to liquidate 4 shares or 5 shares of this mutual fund, and those liquidations also happen at the net asset value at the end of trading of every business day, and then the funds come into your account on the next business day. So if you were to sell a share of a mutual fund today, you would receive the proceeds of that sale basically tomorrow. There are 2 negatives of the mutual fund structure, which is one of the reasons why ETFs have become a more popular product. So one of those negatives is that, one of those negatives is that if a mutual fund gets a lot of redemption requests, so if many people want to cash out and get cash for their shares of the mutual funds keep a certain amount of cash on hand that they can use to meet redemption. So if you're an investor in a mutual fund and you say, I want back $10,000, they usually have a fair amount of money on hand that they don't have to sell anything and they can just give you cash. The negatives of that is that they need to keep cash on hand and that cash isn't invested. So it may earn over time a lower return than if it was invested. And if they get a lot of redemption requests, they may need to liquidate securities, say the next business day. And they may, if they're getting redemption requests at a time when there's been a big sell-off, they may be forced to sell those securities at say low prices. And sometimes if they get a lot of redemption requests, the fact that they all are selling can actually exacerbate the sell-off that's already happening in the market. So there are some negative feedback loops from redemption requests to funds selling to prices falling to them getting further redemption requests. And that's a dynamic that my colleagues in academia and some folks at Columbia Business School actually study. The other negative about the mutual fund structure is when a mutual fund sells and it generates taxable gains, say it generates a taxable capital gain, that capital gain is actually shared by all of the owners of the mutual fund, even those who didn't sell. So if you own a share of a mutual fund and you don't sell your share, but some other folks sell their share, which causes the mutual fund to have to sell some of its holdings, and generate capital gains, those capital gains flow to the holders of the mutual fund, even for those holders who didn't sell themselves. So you may own a share of an S&P 500 fund, and there's a big sell-off in stocks that year, and redemption requests come into the fund from other investors, not from you. The fund may then have to sell some securities it owns, potentially at a profit. It generates capital gains, which are then passed on to you at the end of the tax year, and then on your 1040 at the end of the year, you have to report capital gains, even though you didn't sell anything, and even though you may have lost money in your investments because of this sort of quirky tax structure that mutual funds have. So this is one of the negatives of the mutual fund structure. And kind of to address that negative, people created these things called exchange traded funds. Exchange traded funds are like closed-end funds, except they solve one problem of closed-end funds, where a closed-end fund is effectively like a company that owns a bunch of shares, but there's no mechanism for that company to either buy, to create new shares, or get rid of old shares. The shares just stay out there. And sometimes what happens with closed-end funds, which trade like stocks in the stock exchange, is that there end up being gaps between the market price at which the closed-end fund is trading and the value of the underlying securities that it actually owns, which is called its net asset value. So closed-end funds can develop these big gaps between their market price and their net asset value. And it's very difficult actually to make those gaps go away. Sometimes they persist for years on end. ETFs were an attempt to sort of keep the nice feature of exchange traded funds, which is the fact they trade on the exchange or sort of minute by minute liquidity, but get rid of the undesirable feature that the net asset value and the market price of the closed-end fund aren't aligned. So the way that ETFs solve this is they effectively trade like stocks, and rather than redeeming your shares as you would with a mutual fund, you simply sell shares of the ETF that you own on the exchange. If you want to add new shares, you don't have to wait until the end of the day and buy at the NAV. You just buy shares as they're traded in the market. What's nice about exchange traded funds, which I'll mention briefly without getting into the mechanism, is there is an entity for an exchange traded fund called an authorized participant. And an authorized participant is a professional investment firm that's supposed to ensure that the ETF, and if you want to read about this, by the way, it's the next slide here in the presentation, but I'm not going to go over the mechanism. I'll just briefly mention what it does. So the authorized participant, if the exchange traded fund is trading effectively too cheaply relative to its net asset value, the authorized participant can go into the market, buy the cheap shares of the ETF, unwind them, and convert them to the underlying securities that are owned by the ETF, and then sell the securities at the NAV and sort of lock in that that gap. On the other hand, if the ETF is trading above the NAV, what the authorized participant can do is buy the underlying basket in the ETF at the prices of the underlying securities at its NAV, create a new share of the ETF, and deliver that new share into the marketplace and sell it at the higher than NAV price, and sort of lock in a riskless profit. So the mechanism of having authorized participants who can create or destroy shares of ETFs when they deviate in value from the NAV effectively ensures that the market price and the NAV of ETFs are always very close to each other. The other nice thing about, and I'm trying to see if it's on the slide here, it may not be, but the other nice feature of the ETF structure is that they're very tax efficient in the sense that the ETFs trade a little bit, not nearly as much as mutual funds, because they don't have to accommodate redemption requests. And when they trade and they generate capital gains, those capital gains are passed on to the ETF holders, but they don't have to sell when they get a lot of redemption requests, because that's not how it works. The ETF holder doesn't redeem their shares. They just sell shares of the ETF in the marketplace. And when they sell in the marketplace, if you're an owner of that ETF and you don't sell, you don't experience any capital gains because other people sell, but you do in a mutual fund. So it's a more tax efficient structure because what others do in an ETF doesn't affect your own realizations of capital gains or losses, whereas in a mutual fund, what others do might impact the capital gains, the realized capital gains or losses that you experience. So both ETFs and mutual funds are very important market instruments, and they're both in the tens of trillions of dollars of market cap in terms of the prevalence of the products. But the growth has been really coming on the ETF side of things and less on the mutual fund side of things. And you can see a lot of these statistics if you're interested in this ICI fact book. So that gives you a little bit of a sense of, I mentioned stocks versus bonds, how those products are different, how the incentive structure is a little bit different from, management teams favor stockholders over bondholders. And then you have mutual funds and ETFs, and ETFs are the slightly more, tax efficient structure for most investors. In addition to, the things that invest in public markets like stocks, bonds, which are the public markets themselves, or mutual funds and ETFs, we also have a big area called alternative investments. These are things like private equity, private credit, venture capital, hedge funds. And what's been happening in the alternative space, and I give you some links here, which you can read. There's an article from the Wall Street Journal talking about how pension funds piled into private equity over the last several decades and are actually now having a hard time getting out. So one of the big trends that's been going on over time is that the amount of private equity allocations of pension funds have been growing, quite steadily. So that's like sort of these bottom blue bars. What's been shrinking to make room for that are the public market allocations of these pension funds. So their allocation to stocks and bonds have been falling, while their allocation to private equity has been increasing. Private equity, hedge funds, private credit, all share several features that are common between those asset classes. They're fairly expensive, so they have quite high management fees. I'll give you a little bit of a sense of that in a minute. They're fairly liquid in the sense of like you can trade a stock or a bond, basically daily whenever you want. You have mutual fund daily liquidity with some exceptions. In stress times in markets, they don't have to provide daily liquidity, but the vast majority of the time they do. And one of the reasons they do is because they own very liquid underlying securities. So as they get redemption requests, they themselves can sell, off parts of their portfolio and, generate cash to send back to their shareholders. So they're quite liquid. On the other hand, private equity, private credit, hedge funds are very illiquid. Oftentimes, they have investment horizons that are measured in the years, and they give occasional opportunities for liquidity to their investors, but they are not nearly as able to provide liquidity because they own such illiquid underlying pool of assets as mutual funds and ETFs are, which invest in public markets. So when people invest in the private markets, they often have a hard time getting out. And actually, that's what this article is talking about, that all these pension funds piled into these kind of very liquid products. And then when they needed to pull money out, they actually couldn't because there were no one was providing liquidity to them. Like the private equity managers, like the general partners in those deals couldn't cash them out. And there were other investors who were willing to take over their stakes, but usually at a steep discount to the net asset value that the pension investors thought that their investment was worth. They couldn't get those kind of prices in the secondary market. And the other negative about these asset classes is they're quite opaque. So whereas if you invest in an ETF, you can easily look up, what securities the ETF owns. I mean, they actually have to provide that information on a regular basis. Same with a mutual fund. And when you see the securities that they own, typically they're publicly traded companies. You can go and read about them and research them. With private investments, these are typically smaller companies. They're not publicly traded, so they don't have the same disclosure requirements as publicly traded companies do. And it's very difficult to actually understand, like, what does the basket of underlying investments look like in one of these private equity deals. And the other complicated part is the structure itself is fairly complicated. Like when like how the fees are charged, how the assets are accounted for, like how they're actually valued, is fairly complicated. And many investors, especially retail investors who don't have the institutional support to actually study these deals and really understand them, often don't have a lot of information about how these deals are structured. So alternatives are an important asset class. They've been getting a lot of institutional inflows over the last several decades. And the trend that we're seeing now in the marketplace is a push to create retail products that allow retail investors to access these same investment pools. And what I would say here is you just have to be careful, right? Because as I mentioned, they're illiquid, they're high cost, they're fairly opaque. And as an individual investor, when you're investing in these deals, you usually don't have as much information as institutional investors would have. And so you might be at a little bit of a informational disadvantage. Historically, the reason that institutions piled into alternatives is because alternatives outperformed public markets in the past. So if you look at the last several decades, like here are some statistics from an article from the Wall Street Journal, and here's some similar statistics from an article from the Financial Times. These articles, the links to them are given at the bottom of the page. So over the last 20 years, based on this measure, this MSCI private equity index, the annualized return of private equity the per year return over the last 20 years has been running kind of in the mid-teens, whereas the return from public markets has been running just short of 10%. And by the way, a 10% return is a fantastic return. I think if all of us could have confidence that our stock investments or our investment portfolios would earn a 10% return over the next 10 or 20 years, I think we'd be quite happy with that. But private assets did even better than that. And it's this really good performance that happened in the past that's attracted institutional investors to this asset class. Now, but as you imagine what happened, I mean, you can imagine what happened with this sort of dynamic. As performance was good and institutions invested, what was a little niche industry grew bigger and bigger and bigger and became not a niche industry, but a very large industry nowadays. And some of the early amazing investment opportunities that those PE companies had 20 years ago have begun to dry up. Why? Because there's so much private equity money chasing those opportunities. There's so many investors who still would like to invest in this asset class that they're just not finding the same kind of deals anymore that they used to in the past. And what these studies are pointing out is that while over maybe a 20-year horizon, PE did really well, if you look at the last 5 years, the return on private equity and public markets has been the same. Over the last 3 years, private equity may have done a little bit better, but over the last year, and this is the year ending in 2024, and I don't have the statistics for the year after that. Actually, S&P had a return in the mid-20s, while private equity had a return in the high single digits. So, and the FT article is sort of making the same point that over the last 1, 3, 5, or 10 years, so this FT article is a more recent article. It's from June of this year. Over the last 1, 3, 5, and 10 years, actually, public markets, as measured by the S&P 500, so public large companies have outperformed private investments. There are some concerns now that as a lot of the new sort of private product is being pushed to the retail channel, and retail investors, as I mentioned, don't have the same resources to analyze these deals, that there might be some adverse selection going on that individuals are being offered deals which effectively are being sold by the institutional investor. So the retail channel might become a little bit of a, like a back door for institutions to get out of their private equity investments that they haven't been able to get out of. So I'm not saying that private assets don't have a role to play in retail portfolios. They do, as I already mentioned, diversification matters, and this is another asset class, so it might offer diversification benefit in investor portfolios. But you should be careful and be aware of all the issues around this asset class, and really do your homework, or work with an advisor who can help you to help you to do your homework effectively, because again, these are high cost, illiquid, opaque, and you are at an informational disadvantage relative to the institutional investors in these asset classes. So something you have to be cognizant about before you invest. And I think you will begin to see more and more over the coming months and years, a lot of retail product offering exposure to private asset classes to individual investors. And I hope I've at least motivated you to do a lot of homework before you invest. Okay, so I gave you a little bit of an overview of the investing landscape at this point. So we talked about stocks and bonds, mutual funds and ETFs, and a little bit about the alternative space. There's a lot of blue links there you can click on to read more about this stuff as you see fit. Okay, the next thing I wanted to show you is a little bit of the kind of fees that you might expect to pay to get access to some of these professionally managed products that we just discussed. So let me explain what this table looks like. There are several categories of investment products. These are kind of a mix of some mutual funds and some ETFs. They're interspersed in the table. And the categories that I wanted to sort of mention to you are broad US exposures, broad international exposures, style exposures, and then things that look at stock selection or give you exposure to alternative asset classes. So I've mentioned, some of the investment products that are out there. Now I want to talk about some of the fees that are associated with these things. Okay, so in terms of broad access to US markets, the fortunate state of the investment universe today is that you can get access to really highly diversified, professionally managed pools of assets at very low fees. So probably the most liquid ETF out there is called the SPY. The SPY is an ETF that tracks the S&P 500 index. It has assets under management of $650 billion. And its annual expense ratio is 9 basis points. So a basis point is 1/100%. So when you invest in SPY, you're paying a management fee to the company that manages that ETF. But for every $100 that you put into that ETF, the management fee that you pay is 9 cents, which is very low. What's interesting, however, is that there's alternative ways to get exposure to S&P 500, which is the broad US stock market index. One of them is through a mutual fund called VIIIX, which is run by Vanguard. There are actually many other mutual funds that give you access to the S&P 500. This mutual fund has 300 billion assets under management, so it's quite large. But remarkably, its annual expense ratio is actually only 2 basis points. So for every $100 that you invest in VIIIX, you don't even pay 9 cents. You actually pay only 2 cents. So it's remarkably cost efficient. And the reason it's in green is because of the 3 different products that all give you S&P 500 exposure, which is the SPY, VIIIX, and VOO, which is a Vanguard ETF that tracks the S&P 500. The VIIIX is the cheapest one, 2 basis point management fee. the VOO, is also pretty cheap, 3 basis points. And actually, it's the biggest one. It manages $710 billion of assets under management. So if you want to get in one investment a broadly diversified exposure to the US market, the management fee, the cost of that exposure is 2 or 3 basis points, which is 2 to 3 cents for every $100 investment that you make. So it's extraordinarily cheap actually to make these kinds of investments. As you move to international investing, the cost becomes a little bit higher. And here I again want to emphasize the importance of doing your homework. So for example, the ACWI is an ETF that tracks it's by BlackRock, so it's the iShares ETF. It's one second, just making a quick note for myself. It gives you an exposure to a global index of kind of the world stock market, not just the US, so all countries. So it's a very, very diversified index. It's not 500 stocks, it's like thousands of stocks. And the assets under management of this ACWI ETF are 23 billion. And its annual expense ratio is 32 basis points. And by the way, the expense ratio data I'm getting from Bloomberg to make this table. But what's remarkable, well, not remarkable, but interesting at the very least, is that there's another ETF called VT, which is the Vanguard Total World Stock ETF, which is effectively not exactly the same index as the ACWI, but almost the same index. And you can see that their last year's return was basically identical. And the rightmost column here is a measure of volatility. It's how much their returns tend to wiggle up and down. To get a sense of volatility, look back at last week's lecture because we spent a fair amount of time defining volatility, giving some intuition for volatility, and like explaining how to interpret volatility. But it's a measure of like the dispersion of annual returns. So these are very similar products. But the management fee that you pay to the VT ETF is only 6 basis points. So here you have, almost an identical product charging you 32 basis points of management fee per year. And here you have another one charging 6 basis points. So as you're kind of, investigating how to position your portfolio, the two things you should be thinking about is, investing in ETFs or mutual funds that are liquid, that allow you to, come in and out, sell or buy whenever you want, and that have very low cost. So you should really, try to kind of figure out that sweet spot between, there may be multiple ETFs that track the same index, but one of them may be very liquid, so it's very hard to trade it. And even if the illiquid one has a very low fee, you may still want to choose a more liquid one with an even slightly higher fee because the ability to get in and out is worth something. But if things are equally liquid, like the VT and ACWI would be examples of things that are fairly, have about the same amount of liquidity, you probably should opt for the one that has a lower management fee. There's another example of this actually. There is the EEM, which is an iShares ETF that tracks emerging market stocks. So think here like Brazil, Turkey, Argentina, et cetera, India. And there's another one from Vanguard called VWO, which effectively tracks the same index. But these have a much larger difference in fees. So the EEM charges 72 basis points. So that's for every $100 you invest, 72 cents of management fee per year. Whereas the VWO gives you a very similar exposure with only 7 basis point management fee. So again, here you can save yourself almost a little over 0.5% a year of return, just by investing in what is effectively an all, similarly liquid product, maybe not quite as liquid, but almost, but with a much lower management fee. So as you are thinking about how to construct your own portfolio, you should be thinking about, how can I get the exposure that I want at the lowest possible fee while maintaining, an acceptable amount of liquidity in your portfolio. So the cost of broad US exposure is about 2 basis points. The cost of broad international exposure, if you buy the sort of, the cheapest in class fund, is maybe in the high single digits, like 6, 7 basis points. Then there are what people call style exposures. I'm not going to talk about these, although a lot can be said. Happy to chat afterwards with those of you who are interested. There's things like momentum investing styles, which is to buy past winners and avoid buying past losing stocks. Historically, momentum, that investing style, has tended to do well. There is a well-known strategy called value investing, um, which is buying stocks at inexpensive valuations measured by things like price to equity ratios, which we'll talk about in a few minutes. Um, there's small cap investing, which is like buying small cap stocks. And then there's growth investing, which is kind of related to momentum. That's buying stocks that are growing very quickly. So here, think like, Nvidia, uh, Netflix, those kinds of companies. Um, and the management fee for those exposures is a little bit higher than for those very passive, like index type exposures to US or international markets. So for example, the iShares Momentum ETF charges 15 basis points, so 0.15% management, 15 cents for every $100 you invest. VTV, which is a value ETF, so it invests in like, cheaply valued companies, is also very cheap, actually, like 4 basis point management fee. Small caps, which is this Russell 2000, 19 basis point management fee, so a little bit higher. The Russell 1000 Growth ETF um, gives you a management fee of 18 basis points. So again, a little bit higher as well. So you can sort of see, like, as you get into the slightly more sophisticated sort of style-based investing products, the fee that you should be paying grows. It's still very attractively priced. Like, you're only paying, 15 cents for every $100 investment, but it's a little bit higher than 2 cents for every $100 investment. And finally, as you get to the highest tier of fee product, these are things like stock picking mutual funds. So one of the famous stock picking mutual funds is the Fidelity Magellan Fund. And the Magellan Fund charges a fee that's a little bit over 0.5% a year, so 0.56% a year. There's another fund from T. Rowe called the T. Rowe All Cap Opportunity Fund, and that charges a fee of 79 basis points, so almost a full percent a year. And so as you go from passive US, passive international style-based investing to stock picking funds, the fees become higher, considerably higher for the stock picking funds. And of course, as you pay higher fees, the hurdle for the kind of return that those funds generate becomes higher because you're paying such a high fee. Interestingly, in the last year, just looking at the last 12 months, Magellan performed like in line with the S&P. It underperformed slightly some of the international exposures over the last year. The T. Rowe Price All Cap Opportunity Fund had a 14% return over the last year, while the S&P 500 had a 16% return. So it actually underperformed the S&P, even though you're paying quite a high fee. Historically, mutual funds have had a hard time kind of earning back the fees that they charge to their investors. There's a lot that's been written about this. You can read about this on your own, but that is one little factoid that's out there, is that as an industry, mutual funds have typically have not earned back their fees. And this is most relevant to like the stock picking mutual funds, like the ones that there are some examples here. As you move to mutual funds that give you exposure to alternative asset classes, like you have VFlex, which is run by a company called First Trust. It's something called their Alternative Opportunities Fund. Calamos, which is a company that offers derivative, like option-based products in addition to some alternative products, has this alternative credit fund. You can see that the fees now are much, much higher. Like the annual fees charged by these funds are in the 2 to 3% range. So 300 basis points, 229 basis points. So suddenly the fee went from 0.02%, so that's 2 cents for every $100 invested to $2.29 or $3.15 for every $100 invested. So you can see how the fees, ramp up really, really quickly as you get into the more esoteric products. So as I was mentioning, yes, you can invest in alternatives. They're illiquid, they're opaque, they're high fee, and you can sort of see that here. And then BDCs are something called business development corporations. Think of this as like a self-contained little private equity fund that invests in whatever businesses it wants to invest in. And this particular BDC charges an annual fee of 12.86%, if you believe the Bloomberg data. So you can see how the fees can become extraordinarily high as you move from the very liquid sort of index type products to the more esoteric, either stock picking products or especially the more esoteric private products. The fees just get higher and higher and higher. As again, not to say you shouldn't invest in these things, but before you invest in them, you should do your homework, right? So, and you can sort of see the reasons for why you would want to do your homework in this table. Let me briefly mention that some funds, not many, but a few, charge what are called front-end loads. A front-end load is a fee that you pay on day one when you invest in the fund. So if a fund has a front-end load of like 4%, it means we put in $100 to the fund on day one, the management company takes $4 of your $100 investment. I've never come across a fund that I thought showed a compelling reason to ever pay a front-end load. So if you are confronted with a front-end load fund, I think the hurdle they have to meet to justify charging you a front-end load of 3, 4, 5% of your investment is extraordinarily high. Again, maybe once in a blue moon it makes sense, but I think you should have a fair amount of skepticism when confronted with front-end load funds, and really do your homework before you decide to invest in those. So I hope that what I just showed you gives you a sense of the kind of investment products that are out there. The investment universe is a little bit bewildering. There's many different products, and I've shown you kind of the simpler ones. They're more complicated ones like option-based strategies and derivative-based strategies, and God knows whatever hedge funds are doing. So you got to be a student of this stuff and show a healthy skepticism and a willingness to work and do the research, and not commit your money to things that not invest in a 72 basis point ETF when there's a 7 basis point ETF that gives you effectively the same exposure. So you have to really do your homework. So let's now talk about how you take all of these kind of lessons to the level of your overall portfolio and how you would think about constructing your own portfolio. So lesson number one for constructing your own portfolio is make sure that you have a diversified set of investments. It's very easy to get diversification. I just showed you many investment products. There are also ones that invest in corporate bonds that I didn't discuss, but they're also low cost investment in bonds of both high yield and investment grade and other types of bonds. So you want the diversified exposure, and really, really importantly, you want to have a risk appropriate portfolio. So we haven't discussed it this week, but we did discuss it last week. So I'm not going to talk about it, but I would encourage those of you who haven't seen this table, which we talked about last week, which shows you the relationship between risk and return in financial markets. It's this table in this chart that's earlier in this presentation. I strongly encourage you to go back and listen to that part of last week's lecture and really internalize that trade-off between risk and return, and make sure that you're choosing an investment that has a drawdown level that you're going to be comfortable with. It has a worst case drawdown level or historical worst case drawdown level that you're actually comfortable investing in. Once you decide what the appropriate risk level is, the best option for the vast majority of people is to use low cost liquid mutual funds or ETFs to get those exposures. For most people, outside of just playing around with investing in stocks, you're not going to do a good job investing in stocks if you're like most people. I'll give you some examples of this in a second. If you touch alternatives, which you can, and you will have more opportunities to do so, like one of the things being discussed now by the Trump administration is giving people access to alternative investments in their 401ks. Again, I'm all for market access. I mean, I think it's great to give people choices, but I warn you that you have to carefully research the choices that you're going to be given, and make sure you understand these high fee, opaque, and illiquid investment products before you invest in them. Um, Another, I think, the truism of financial markets, if you are a non-professional investor and you don't run a family office and you don't work at a hedge fund, and you haven't been trained by someone who is conversant with this stuff, avoid leverage and avoid short selling. Just don't do it. When you use leverage to invest, or when you do short selling, which is borrowing a security you don't have, selling it in the market, getting the cash from it, hoping that security falls in price, so you can buy it back at a cheaper price and deliver it back to the person who lent you that security. These types of trades are very, very risky. There are endless stories of funds run by really smart individuals who use too much leverage, who used excessive short selling, and basically, destroy their business. And these are professionals who have been trained in markets. So if you're an individual investor, I cannot think of any reason why individual investors would engage in leverage and short selling unless they're really, really knowledgeable, expert investors. So I, give you that as a cautionary note. The other thing you should be very aware of is not to overtrade. So let me give you an example here. This is a famous study done by two financial economists from UCal Berkeley, Barber and Odine. And this study done about 25 years ago, where they obtained data on 78,000 accounts from a large brokerage firm. And they effectively knew every trade that was done in those accounts over a 5-year time period from January of 1991 to December of 1996. And what they found, actually, I guess that would be a 6-year time period, not a 5-year time period. They took each of the accounts they had of the 78,000 accounts, and they put them into buckets based on how much those accounts traded. So simply, bucket one would be the accounts that traded the least, so they just bought some securities, held onto them, and almost never traded. And bucket five were the investors who traded the most, who were very actively trading, buying and selling, buying and selling. The chart here shows you the gross and net return of those investment portfolios, and the gray bar shows you the turnover. The punchline, as you can see from this chart, is that the accounts that traded very little, so see the turnover bar for the low turnover accounts is almost zero, so they're effectively buy and hold accounts, buy, hold, don't do anything. These accounts did the best. Their net return, the return after trading costs, was something like high teens. So this was a time period that markets did very well, and they earned something like, I don't know, 18% returns after fees in their portfolios. They concentrated a lot, in addition to the fact that they generated even gross fee returns that were lower than their low trading counterparts. When you look at their net returns after fees, were about 5 percentage points lower than the accounts that traded less. So basically, trading more simply destroyed wealth. Even if you don't take into account the cost of trading, they didn't do any better. So they had no particular ability to actively trade, like they didn't have any special secret sauce. But by trading a lot, they massively hurt their returns, and they did the worst. And in fact, there's a monotonic pattern from bucket 1 to 2 to 3 to 4 to 5 of decreasing net returns in each of those accounts the more people traded. So that's one bit of caution. Like, again, unless you are the exceptional individual, by trading a lot, you're typically not adding value. You're often subtracting value. Another way to see how much trading subtracts value is in an annual study that's put out by Morningstar. So Morningstar does a lot of really excellent research on the investing space, like Morningstar does mutual fund rankings, for example, that are very informative. They track the performance of trading accounts relative to the performance that those trading accounts would have had if they simply held the portfolio that they held on average and never traded it. And what they find is that the average dollar invested in US mutual funds and exchange traded funds earned 6.3% over the 10-year period ending in 2023, which was about 1.1% less than the actual return earned by those same funds over that time period. So basically, what was happening is that individual investors were systematically selling mutual funds at times when they should have been buying them, and buying them at times when they should have been selling them. And by actively trading mutual funds and ETFs, these investors were actually degrading their performance relative to how well they would have done if they simply bought and held those same assets. And what this table shows you at the bottom is a decomposition of that tendency of the actual realized return versus what they would have earned if they never traded, grouped by different asset classes like alternatives, international equity, sector equity, U.S. equity, et cetera. So you can download this report from Morningstar. By the way, it's a freely downloadable report. You'll just have to put in your contact information, then they'll send you the link to it, and you can read more about it. But the general punchline of the evidence here is that overtrading is bad. Trading a lot is bad. Usually people don't have a lot of ability to actually time markets, and by trying to time markets or trying to time individual securities, people typically make their performance worse than it would have been if they didn't engage in active trading. So as you're thinking about constructing your portfolio, just do the research. Here's a paper, you can read the documents, the benefits or the drawbacks of overtrading. Here's another paper that documents that. And there's another link to an academic study done by two Harvard economists, Greenwood and Schleifer, that talks about how people, when they do surveys of investor beliefs about market returns, investor beliefs about market returns are systematically wrong relative to what actually rational investors would believe. So again, you can read the paper, but there's a lot of evidence that says individuals systematically make bad decisions when it comes to investing in financial markets, so something you should be aware of. Okay, talking about individuals investing in financial markets, one of the things that people often talk about with regard to market timing is something called the price to earnings ratio of the broad market, or something called the CAPE ratio, which stands for the cyclically adjusted price to earnings ratio. And let me say at the outset, it is very difficult to forecast the direction of stock market returns over the next month, 3 months, or year. Maybe it's not impossible, but it's very, very difficult. One way people try to do this is by using this thing called the CAPE ratio, the cyclically adjusted price to earnings ratio. What this ratio does, it measures the current price of the S&P 500 index relative to the average S&P 500 earnings per share over the last 10 years, when you normalize both the current price and the earnings stream of the S&P by the level of inflation. So it's like comparing real prices, real in the sense of deflated by inflation, to real earnings. Again, real in the sense of deflated by the rate of inflation. This CAPE ratio was constructed by two economists, John Campbell and Robert Shiller. And the way you can think about this is basically for every dollar of earnings that stocks generate, how many dollars are you paying to buy a share of the stock? And the less you pay relative to earnings, the cheaper people would say the stock market is. And one of the things that you may have heard about the CAPE ratio, certainly something that's covered by the popular media a lot, and it's been written about by many investors, professional investors, and like social media types and so on, is that the current level of the CAPE ratio, this price to earnings ratio of the broad market, is quite high. So right now, for every dollar of earnings, average earnings of the S&P deflated by inflation over the last 10 years, you're paying about $35 of stock value. At the depth of the global financial crisis, you were paying something like 15 times earnings. So for every dollar of earnings, you're paying $15 worth of stock prices. Now you're paying 35. And this peak in the CAPE ratio came right in front of what's called the dot-com bubble, which is when we had the first wave of internet companies in the late 90s and early 2000s. And then you had a big bubble burst in the market, and the market was down to something like 50%. That happened at a time when there was a very high cyclically adjusted price to earnings ratio in the market. Another time the CAPE ratio was very high was here, which is right before the Great Depression. So, so they're famous episodes um, of elevated historical CAPE ratio. And today, it's also relatively elevated. Now, the CAPE ratio can be elevated for one of two reasons. Without getting into the math of how these things are determined, the price earnings ratio of stocks can be high either because people demand lower expected returns for owning the stock market. So one of the interpretations of a higher CAPE ratio is that the future return of stocks might be lower than it would be when you have a lower CAPE ratio. The other reason you might have a high CAPE ratio is because people believe that the growth rate of earnings over the next 5-10 years will be very high. And unfortunately, it's very difficult to disentangle those two drivers. So it's very difficult to say, is the CAPE ratio currently elevated because people believe, because of AI productivity boost and so on, that corporate earnings per share will grow so much over the next 10 years that we actually don't mind paying a lot for the current $1 of earnings, because this current dollar of earnings in 10 years is going to turn into, I don't know, $2 of earnings or $2.50 of earnings or whatever. It'll really grow massively over the next 10 years. So that's one possibility. The other possibility is that stocks have this high CAPE ratio, and that really means that they'll have lower returns in the future. Unfortunately, while the CAPE ratio has historically been associated with a higher CAPE ratio has historically been associated with lower future returns, that association hasn't really worked very well over the last several decades. I give you a link here to an article, something that we put together at QuantStreet that basically documents this. So let me not get into it now because I think it'll take us a little too far afield. But one thing just to keep in mind is you'll often see this kind of table. Just let me briefly explain what this table means. This table shows you the CAPE ratio, so the cyclically adjusted price earnings ratio at the end of a given month, from the lowest bucket. So this is CAPE ratios from 4.7 to 9.6 to the highest bucket, which are ratios from 26 to 44, which is where we are today. Today, the current ratio is 35, so you're paying $35 of market value for every dollar of earnings, and that puts you in the highest historical bucket. So what people will point out is that the 1 year ahead return from the lowest CAPE ratio bucket has been on average 20.6% per year, whereas the average return from the highest bucket has been 7% per year. But there are so many caveats with this table that in terms of its actual forecasting power over the next 10 years, I'm very skeptical. Some people are not. Some people believe that because the CAPE ratio is high, it means returns on the US stock market will be low over the subsequent 5 to 10 years. I'm not a believer in that. This is a good time to show you the following slide, which I didn't show this time around. Investing in financial markets involves risks. Investors may lose money. Nothing I say in this presentation should be construed as investment advice. This is just an educational seminar. I don't know enough about your own circumstances to give you investment advice. The best forecasting models, the most well-intentioned market forecasts, have a tendency to go horribly wrong when it actually comes to what happens in markets. So I just want to warn you that I don't have a crystal ball. Nothing I say should be interpreted as if I do have a crystal ball. And you should take all of these sort of forecasts with a big grain of salt. But it is empirically true that over the last 10 to 20 years, having a CAPE ratio in the sort of higher end of the range has not been a good forecaster for future stock market returns. My own view is that US earnings per share over the next 10 years might indeed grow more quickly than they have grown historically, because I am a believer in the AI productivity miracle that people are hypothesizing might actually happen to financial markets. And that might justify, the higher valuations. But anyway, I give you a link here to an article that we wrote at QuantStreet that you guys can read. In addition, if you're interested in understanding more about the CAPE ratio, just search for it on Google. There's lots and lots of resources out there that'll point you towards, towards additional information. So I go back to this slide that says it's very, very hard for individual investors to time the market. People will often look to the CAPE ratio as one tool to help them time the market. It's worked well in some historical time periods, but not over the last 20 years. And as a forward-looking tool, I think the CAPE ratio is probably too simplistic. There are more subtle analyses one can do. We try to do a more subtle analysis. At QuantStreet, it has many assumptions built into it, but I think it makes us a little bit more sanguine in the US market than the CAPE ratio would suggest. But by the way, even if the CAPE ratio, even if it's able exactly right, it forecasts an average annual return over the next 10 years of 7%, which isn't the best 10-year period in markets if you have a 7% annualized return, but it's also not the worst thing that can happen either. So it's you have to take these forecasts with a grain of salt. Okay, so finally, I wanted to mention, and just to give you some pointers. So as you are thinking about investing in financial markets, obviously, as we discussed in last week's lecture, we're more foundational about how to do risk measurement and what the long-run investment performance of stocks and has looked like, and bonds has looked like over the last, post-World War II, and actually over the last 400 years. So there's a lot to know. There's a lot to understand. There are products have embedded leverages, products engage in short selling that you may not even know. I mean, it's a bewildering universe of stuff out there. And that's not even to mention all of the financial planning questions that you may have, right? Things about like how much you should be spending, when you take Social Security, how to do things like Roth conversions, how to think about a 529 accounts, how to do these things called 351 conversions. How to determine the appropriate risk level for you, how to manage legacy portfolios. So if you're sitting on a portfolio of 20 stocks that you inherited from your parents or grandparents, and they all have, they're all massively appreciated, so they all have very large unrealized capital gains, and you're afraid to sell them because if you sell them, you have to pay high capital gains, but you have a highly non-diversified portfolio. Like, how do you deal with that stuff? So these are all dimensions of the investing decision-making process that advisors can help with. When you research an advisor, you have a great tool available to you, which is called this IAPD website. So it's run by the SEC, the Securities and Exchange Commission. And they give you two pieces of information, actually more than that, but at least two important pieces of information for every investment advisory firm. So you have financial advisory firm XYZ. You met them at your local golf course, what have you. You want to learn more about them. You can go on this website, type in their name into the search bar, and it'll give you what's called the 4 Means EV Part 1 and the 4 Means EV Part 2. The 4 Means EV Part 1 will tell you like who are the principal owners of the firm, how much assets under management they have, what kind of strategy, what kind of services they provide, a little bit about their fee structure. It gives you just a lot of information about what that financial advisor does. And then there's something called the 4 Means EV Part 2. So the Part 1 is more, it's a lot of like data, a lot of tables. The 4 Means EV Part 2 is more like a PDF file that has a narrative description of what the advisory firm does. So it'll talk about how they think about risk management, what their fee structures look like, what kind of strategies they offer, what services they provide. It's mandated by the regulators that you have to make these disclosures. They're publicly available. You can also search for the advisor directly. So if you have a name of an advisor you may consider working with, even if they're part of a bigger firm like Morgan Stanley, whatever, that advisor should also be available on this website. It'll give you their entire career history. It'll show you what firm they've ever worked at, whether it's a broker dealer or an investment advisor. So you can learn a ton about the investment advisor, him or herself, and the company, and the fees they charge, and the strategies they run by going to this website and doing research. So I think choosing an investment advisor is a lot like choosing a mutual fund, right? It's complicated. What they do is complex. They can help you make these decisions, but you have to do your homework. And the really good way to do your homework, in addition to talking to multiple people, multiple advisors, and really, finding the person that you're most comfortable with, whose view on markets resonates with your own investing views, who can help you with the kind of financial planning you need to do. You can also go and research them on these publicly available resources and learn a lot about them, like disciplinary history and all these like career trajectory, all this sorts of stuff. It's all available. And I think people, many investors would save themselves a lot of headache by just doing this kind of research, which is part of the investment process. Like for a lot of people, working with an advisor makes sense. And if you do so, you have to do your research. I here give you a list of questions that you might consider asking your financial advisor when you meet with them. I won't go over them, but you can read this on your own. It's just a list of questions that we've been asked and that I think are reasonable questions to ask someone that you may be talking to. So I'll leave that for you as a further reading that you can do on your own. Okay, and let me wrap up here. So I'm going to skip current state of the business cycle because I don't think we can really do justice to it. But you can look through these slides on your own in your spare time. Let me just give you some pointers to learn more. So I feel like investing is like any other activity that we undertake in our lives. It's complicated. It's very important for you, for your loved ones, for your family, for your future generations of your family. So it's something you should really take very seriously and not just let it kind of happen on its own, evolve on its own. It's something you should be proactive about. And there's a lot of resources that are available that help you become better informed investors. To give a plug to some of our very, very large competitors, places like Betterment, Wealthfront, which are what are called robo-advisors. So they run these like automated investing programs. Of course, Fidelity, Vanguard, BlackRock, many others, they all have research websites. You can go to their website. They publish lots and lots of research about markets, financial planning, what have you, that you would be really well served to read. Actually, Schwab, I should add to this, also has wonderful investor resources. Then there are some great books. One of the classic books in investing is something called A Random Walk Down Wall Street by an economist. His name is Burton Malkiel. It's a wonderful book. It's a little dense in places, but it's written for a lay audience, not for a technical audience. And it walks you through the last like 50 years of thinking in financial economics. A lot of what I've discussed, like diversification, low-cost investments, the fact that people typically can't outperform passive strategies, like all of those things are well documented and discussed in this book. There are some other really nice books by some of the sort of luminaries of the investing world. There's something called The Little Book of Common Sense Investing by John Bogle, who was a founder of Vanguard. Another book called Unconventional Success by David Swenson, who passed away unfortunately at a young age, but who was the former chief investment officer of Yale's endowment. There's a book called The Four Pillars of Investing, which also talks about some of the issues. You can talk to a financial advisor, as I mentioned. I think it would make sense for some of you to do that. And of course, there's QuantStreet, there's us. If you'd like to get some of these research pieces that we put out, we typically publish twice a month, in the middle of the month and at the end of the month. Get on our email list, just sign up at bit.ly/QuantStreet. We write about state of markets, financial planning questions, tax questions, all this kind of stuff. And if you're interested, send us an email at our email address. just to show you, is hello@quantstreetcapital.com. Okay, I have left a few minutes in case there are any questions. So let me stop here and see if people have any questions to ask, and I'm happy to stick around for a few minutes and answer some of them. Okay, I see Linda so Linda, if you can unmute yourself and just ask, I'm happy to hear your question. Or you can type it into chat or unmute yourself. Or maybe that we're having a technical issue.
I click on ask to unmute and she didn't reply.
I see. Okay, so maybe they're having a technical issue or something. Okay, so if anyone else has questions, you can type them into chat or just unmute yourself and ask.
Yeah, just unmute yourself. Just unmute yourself. Yeah, it looks like it's fine.
Okay.
Okay.
Well, if there are no questions, thank you for listening, and I hope you learned something.
Thank you very much, Professor, and thank you everyone for coming. I will email the recording and the slides to all who registered. And just give you we're going to have a new series for financial planning for young professionals in the fall. And in spring, we have another series for financial planning for people who plan to retire. It's more about how to make a will and a trust. So please check our website to find out what's going to happen in the library. Thank you very much. Good night. Oh, wait a second. Oh, there's a question. Excuse me, Professor. Oh, the question just said hello. Okay.
Hello.
Okay, thank you.
Okay.
Okay.
All right. Take care.